So we'll give a few more minutes just for folks to continue to join us, but we'll get started as soon as possible. Thank you for joining us. Hopefully you can see our welcome screen. Well, I think we will go ahead and get started today. Get my camera on so you can see somebody out in the virtual world. Welcome to ForestHer North Carolina's Protecting Your Woods workshop number 4. This is our 4th workshop in this Protecting Your Woods series. So we're grateful that you have taken a few minutes of your time this afternoon to join us, and we're glad to be able to offer these types of programs, whether they're virtually or in person. So we'll continue to take what we can do. We've got about we've got a few more folks starting to join us, but we have 2 great presenters lined up for you this afternoon, and so we hope you will enjoy our presentations. My name is Jennifer Roach, and I am a district forester with the North Carolina Forest Service, and I will be moderating today and helping us guide us through this virtual world. But as we get started, what we missed during the virtual meetings is really being able to communicate and talk with each other, kind of learn a little bit about each other, maybe make some new acquaintances or friends. So as we move forward into this meeting, if you want to type in the chat box where you're joining us today, just tell us where you're seeing this meeting today, or what county you own property in. And tell us, are you receiving a lot of this rain that we've got here? I'm joining us today in Hillsborough, and it is pouring down rain from Tropical Storm Elsa. So tell us what it looks like in your neighborhood. In the meantime, we do want to make sure that everyone on here understands how to communicate with us during these meetings. So Bob Barden with NC State Extension is going to review some of those things with us to ensure that we can all communicate. Bob? Thanks,
Jennifer. Today we'll be using a couple features. Many of you have already figured out the chat window. If you have any technical issues, or as responding to people's questions today is in reference to if one of the presenters asks you to use the chat window, we ask that you limit the text in the chat to things relevant for today's webinar. It's great seeing where everybody's participating from today, so keep putting that in there. We'll be taking questions today. We'll ask that you enter your questions into the Q&A feature of Zoom. Many of you have already participated in the past on the ForestHer webinars, are probably familiar with that. If not, if you just need to click on the Q&A icon, and a window will open up such that you can enter your questions. We will be taking questions throughout the webinar, but we'll address them at the end of today's webinar. Also, we do have closed captioning today, and you can access that by clicking on the CC icon for closed captioning. And I will paste the link here in the chat here in a second, and you'll also can click on that for the closed captioning. If you need to get our attention, please go ahead and just send a message in the chat to the panelists, as well as you can raise your hand, and I'll be watching for that, and then watching for your text in the chat. So if something comes up, we'll be aware of it. With that, though, please sit back, relax, and enjoy today's webinar. We will be posting out a link at the end of today's webinar for a short evaluation that we'll ask you to fill out at that time. And with that, Jennifer, I'm going to turn it back over to you.
All right, great. Thank you, Bob. Yeah, so we have got a lot of folks on here today. We've got 65 people joining us today, and we are seeing folks from Perquimans County all the way to Ashe County, and Franklin County, Davidson County, Orange County, Pender, Bladen, So we've got a lot of folks representing across the state today. And it looks like the line of rain, just based on this, is right here in the triangle. So those of you getting wet this afternoon, I'm sure you're enjoying it, because we're starting to dry up for sure. And maybe those with the west, you may receive a little bit. All right, well, just as a reminder, I think Bob mentioned it, but I just want to remind folks again, this meeting is recorded and it will be available on the ForestHer NC YouTube channel. And so if you will give us about 2 weeks, it takes a little bit of time, because all of us are doing this as a side project from our normal duties. And it will take our webmaster a few weeks to kind of get this posted up on the YouTube channel. But at that point, you will be able to go back and review this meeting entirely as many times as you need to, or see the slides at that point. So just please keep that in mind. This meeting is being recorded, and you can find this meeting as well as all of our previous webinars on the ForestHer NC YouTube channel. All right, so thank you very much. And I guess without further ado, I think everyone is here to hear from our lovely speakers. So Kayla Futrell, who is with the Pender County Tax Assessor's Office, will be our first speaker. Kayla. Might have thrown Kayla off there. I got a little ahead of myself. There she is. So while Kayla's getting ready, I'm sure down in Pender County, they are receiving lots of rain from Tropical Storm Elsa. So hopefully not too much, with a lot of flooding going on, but I know we definitely need the rain statewide. So while we're waiting, I guess we could maybe talk just a second here. We'll just wait for Kayla to get situated. But if you've never checked out the ForestHer YouTube channel, if you like to watch videos on YouTube, I know a lot of folks are. There are some good things on there, but you got to be careful what you're watching, what you're reading, and make sure you follow it up and kind of truth check some of that. But there are lots of other really good things on YouTube as well. And the ForestHer webinar series is one of them. So check that out. All right. So there is Kayla. All right.
Hey.
So Kayla, are you ready? And I will turn the screen over to you.
Yes, I am.
Okay. So if you just want to share your screen, and it will.
All right. My name is Kayla Futrell. I was recently married, and I have been with Pender County Tax Office for 11 years. I love my job. I deal with the present use value program, which I know most of you are probably already in the program, but in case you're not, it does allow you to help with your property taxes. There are 3 programs available: forestry, agriculture, and horticulture. And I do have a presentation to show you guys today. So it's for the present use value program. So the present use value program, in case you don't know, it was created back in 1973. And basically what it is, if you have agriculture, horticulture, forestry, you're taxed at a reduced rate. Now, the rate that you're charged is based on something from the Use Value Advisory Board. They create these rates. And then they're dispersed out to each county, depending on what your revaluation year is. That's what value you would be charged for that particular year. So I do have an example that I want to share with you guys. So a 43-acre forestry parcel in Pender County. The market value is $91,963. The deferment is $78,452, and that's what you're not paying taxes on. So your taxable value will be $13,511. So essentially, instead of paying $763, you're really going to be paying about $111. and it is based on the soil type. That's where the deferment comes from. So yours will not be the same as your neighbors, or if you have multiple forestry tracts or agricultural horticulture tracts, they may not have the same amount that is being deferred for each parcel, because it is based on the soil type. And you may not have the same soil type in each one of your parcels that you have. So like I said, it can be deferred if you are growing agriculture, horticulture, forestry products. Now with this, and we'll get to this a little bit later on in the slide, there is what we call a rollback that would also happen with that. So if you sell the property and the new owner is not going to continue, or if you don't have enough to continue, we will have to issue a rollback bill. And for this example, that rollback bill would be about $1,900, but we'll get to the disqualification later on. So there's an application period, and it is during our listing period at the tax office. It's January 1st through 31st of each tax years. And it can be transferred anytime during that calendar year. There's just a 60-day time frame that we have to work with. So if you purchase a property that's already in use value, you have 60 days from the day of that transfer to get the information into us. It is a voluntary program, so you have to request to be in that program. There are some ownership qualifications, and Department of Revenue, they mandate this program. So they are the ones that said, hey, these are our requirements. They do allow individuals to own the property, husband and wife, business entities, trust, and tenants in common. So those are some of the qualifying owners. With husband and wife, you have to be a natural person like you and I. You have to own the property for 4 full years from the date you're applying. So it would have to be 4 full years. So you don't count the year that you bought it. You count it 4 years from that. Then that next January, you'll be able to apply. Something that can bypass that 4-year ownership rule is if you live on the property as of January 1st. So if you live on the property as of January 1st, then you'd be able to qualify. And there is an exception, and we will get to that later on also. But if you buy a parcel that's already in use value, you can assume the liability and you can qualify immediately for that. Business entities, they can be limited liability companies, corporation, and partnerships. With that, your principal business still has to be agriculture, horticulture, or forestry. And all owners must be actively engaged if you're not related. And if you are related, then at least one person has to be actively engaged. And for corporation, your shares can't be publicly traded. You can't buy stock in it. So if you have any questions about if your LLC would qualify, you would just need to call your local tax office and ask them. Trust, they can also qualify, and it would have to be all beneficiaries are directly or indirectly individuals who are the creator of the trust or a relative of the creator. Tenants in common is another popular ownership, and that would have to be, each owner would have to qualify on their own. So like an example would be Jim and Jack. They would be tenants in common. They're individually own the property. Another continued use we have is when transferring land that currently has deferment, all of the following conditions must be met. The land already has to be in PUV when the new owner buys it. The current owner will continue using the land under the same PUV program. So if you buy it from someone who had it in forestry, you also have to keep that in forestry. And then you have to turn in all the information within 60 days. Along with ownership, we have to have a size qualification. Like I said, we had 3 programs: agriculture, horticulture, and forestry. Agriculture is you have to have 10 acres, and like the row crops must be 10 tillable acres. So you can't have a 10-acre parcel, but only 8 acres planted in corn. Or if you have livestock, if you have cattle, that 10 acres has to be fenced in. You can't have 6 acres of fenced in cattle and you just bush hog and mow the rest. With horticulture, the acreage is 5, and that would have to be row to row. So you would have to have like row to row blueberries, strawberries, grapes, sod, nursery plants. You can't have a 5-acre parcel and only have 4 or 5 blueberry bushes on it and just, bush hog the rest of it, or a couple rows. Forestry, you have to have 20 acres, and there you would have to be underneath the sound management program, and it has to be grown for the commercial production of timber, which means growing it, thinning it whenever it needs to, harvesting it, and planting it back. So you're keeping the timber cycle going. With agriculture, the land has to be actively engaged in the commercial growing of crops, plants, or animals. You must meet the size, income, and ownership requirements to qualify. A few examples of agriculture are soybeans, grains, tobacco, cotton, peanuts, corn, livestock, and commercial poultry houses. Our next one is horticulture. That land has to be in the production of commercial growing of fruits, vegetables, nursery, or floral products. You must also meet the size, income, and ownership requirements. And you could have fruit trees, vegetables, sod, nursery products, and floral products. Forestry, you would have to have 20 acres that is part of a forestry unit that is actively engaged in the commercial growing of trees under a sound management program. Again, you must meet the size and sound management and ownership requirements. With the forestry, you would have to have a forestry management plan. And on the back of the applications, there a place where you can check of who is going to turn in your management plan. It could be the Forestry Service, a consulting forester, landowner, or anyone that does not fit in that category. They would just, check over. With the forestry, it can get kind of, confusing at times. If you have more than 10 acres of agriculture on your forestry tract, then you could also qualify for the agriculture deferment. But if you have less than 10 acres of agriculture, then you would not be able to qualify that. So one of the examples is also food plots. So if you have food plots on your property, that won't qualify. It cannot take away from your forestry deferment that you have. Forestry would have to be your #1 priority. So you could have a couple, plots, food plots in between your rows, and all that would be fine. But when you start going in and harvesting, 1, 2, 3, 4 acres of your timberland for wildlife, then, at that point, timber would not be, your #1 goal, and it just would not be able to qualify. With the management plans, back in 2004, the Department of Revenue made it that every parcel that had forestry deferment have to have a management plan if your tract is over 20 acres. And on the application, they have even given a couple of examples what needs to be in the management plan. And it would have, if you write it yourself, it would still have to meet the same criteria as if the Forestry Service or another professional wrote that. Yeah, so if you want to write your own plan, it would have to still make sure all those points are met. And also it would have to be harvested in compliance with the plan. And that's basically just to keep the timber cycle going. I know a lot of people do not want to clear cut it. If you don't, that's fine. That is your right as an landowner, but it just would not be able to be in the program. You can talk with your Forestry Service, your consulting forester, and you may be able to do like a rotation, so it's not all clear cut at the same time. Like if you have a large tract, you could cut the front now, plant it, wait a couple years, cut the back. But at some point in time, it would have to be harvested, because that's how the timber cycle, it goes. You plant it, you let it grow, you harvest it to keep that cycle going. And anytime something major happens with your property, you would also need to have it updated. So if you have thinning, burning, clear cut, or heaven forbid a wildfire, that is something major, and you would just need to come in and update that management plan with your county. If you split and deed your property, so if you currently have a qualifying tract and it's being split, the new parcels must qualify on their own. So this we run into this quite a bit. You know, your grandparents had the property, you had the property in use value, but then you're going to split it for your children. But example I gave is like if you have a 50-acre forestry tract and it's split, one person gets 10 acres, one person gets 40. The person who receives 10 acres is not going to qualify because it's not 20. So at that point in time, that property would have what we call a rollback bill, and that would have to be due and payable, and it would be to the person who had it in use value. So whoever had that 50-acre tract, they would get the rollback bill for that 10 acres. There is an exception. So if the buyer of that 10-acre forestry tract already has a qualifying forestry deferment, they can do what we call a piggyback. So as long as it's within 50 miles of that parcel, then no rollback would be due for that. And if so, the new owner of that 10-acre parcel can just add it to their application within 60 days. So we've talked about the ownership, we've talked about the size. Now the last part of it is the income requirements. So the land must produce at least $1,000 a year for the past 3 years, or at least $3,000 over 3 years. And the Department of Revenue gives you that 3 years. So in case there's a drought one year, or crops just aren't great, you're not penalized if you don't make that $1,000 that 1 year. So you have $3,000. You have 3 years to make that $3,000, and you would have to show proof of that. You could go get grain receipts, Schedule F tax form. You can go to your local FSA agency, and they would give you a crop report. But we would just have to see that it was in fact planted. Along with that, I know a lot of people have land rent. That land rent that you receive cannot be towards that $3,000, because we're looking at what the land produces. Another part is signing the application. So if you have tenants in common, everybody has to sign, only because the use value, we look at it as a whole. So if you have you and let's just say your brother own a piece of property, you want it in use value, but your brother doesn't. The tax office can't go in and just say, okay, well, you own this half, we'll only give deferment on your half. It doesn't work like that. So everybody has to be on board. So that's why we have multiple owners. We want to make sure everybody understands, the deferment that they're going to be receiving and responsible for. And so that's why everybody would have to sign. And husband and wife, if they're tenants in common, they both would need to sign. If they're tenants by the entirety, then basically just one person would have to sign. Corporations, limited liability companies, whoever's in charge of making the financial decisions for that company, they would have to be the ones that would sign. Partnerships, all partners would need to sign the application. In trust would have to be the trustee of the trust. The audit process. Basically, once you're in the program, we will audit your file about every 8 years. And that is in compliance with our general statute. So pretty much whenever you file the application, what I do in Pender County is we will put the date on the top of the application. So about every 8 years, we'll pull that, and then we'll just do a compliance review. And with our agriculture, it's always the previous 3 years of income. So you would have to submit that information, basically just make sure it's still being farmed. And for the forestry, there's going to be a couple years where it's just going to be sitting and growing, and that's okay. But you just need to update that management plan and let us know what's going on with that. Or if you have done any cutting or burning or whatnot in between the 8-year period, you would just need to update that and let us know. So example was, if your last application was filed in 2020, about 2028, you should be receiving an audit letter. Disqualification is what we also call the rollback bill. And the past 3 years of deferment that you've been receiving, you would have to pay a portion of that back. And that could be, like I said, if you're no longer harvesting the property, if you're no longer harvesting crops or timber, you wouldn't be able to keep up with the program if you're not, doing what the management plan says. And it is, like I said, for the past 3 years, the deferment that you've been receiving will have to be paid back. So that's basically it. The Department of Revenue has a manual out, and it's like 300 pages. If you guys want to go look at it, the Department of Revenue, they are an excellent source of information. You can call your county tax office and speak to someone who handles the use value program. And there are a wealth of information out there. So if you have any questions for me, my contact information is here, and we'll be happy to help you any way we can.
All right, that was great, Kayla. Thank you so much for that information. And we do have several questions for you.
Okay.
And we've got several minutes here, so we've got plenty of time to answer these. So I'll just read them out to you.
Okay.
Oh my goodness, one got moved. Okay, we'll start at the top. All right, can harvesting be deferred for several years due to market prices?
The
forest harvesting.
Yep. So the Forestry Service, along with the Department of Revenue, they gave us about a 5 or 6 year window. So basically, nobody expects you to sell your timber if the market is down, but that's why they give us about a 5 or 6 year window, because within that time, they said the timber market, will have time to come up, or if it's a really wet season, it will have time to dry out. So we can defer it to a certain extent. And basically just as what your management plan says. I can personally speak for myself, like I am, sitting in the office. I'm not actually going out and looking at your property like your forester is. So if your forester says it needs to be cut in 2025, and let's just say, it's just not ready, they have gone out there and they said, okay, well, we can wait a few more years. You would just need to update the management plan, say per forester, we can wait a few more years. And then, like I said, we can give about a 5 or 6 year window. And then if it comes to that time frame is up and it's still not done, and that's when we'll have to look at it as a case by case as of, why it's not done.
Great, thank you. Okay, we got another one here. All right, so I'm going to assume this is in regards to the agriculture use. So
Okay.
if land is rented to another farmer, does it qualify?
It does. That is where you would have to get like the grain receipts or the Schedule F tax form from the Farm Service Agency. So you basically would need to get that information to us saying, there was 10 acres of crops or of corn on this property, and then we kind of know how many bushels to acre, how much it is a bushel, and we can figure it up that way. So it can be rented out. Basically, it just has to be land in production. So you can rent it out to a farmer whenever they collect your product. They may take it to their granary. You can give grain receipts. We just have to see something equaling $3,000 from that.
Okay, great. All right, so we'll switch gears again. All right, so are different regions of the state treated differently? So in the mountains, he talks of rarely planting forest trees or seeing clear cuts. So but there's lots of land in PUV program. So are the regions treated differently?
Well, this program is the same for all 100 counties. So the mountains, the only thing they have different is they have like a Christmas tree deferment that we don't have here, like in the coastal side. But if you're in the mountains and you have 20 acres of timber, it's still supposed to be harvested. I really can't answer as of, why it's not done, but there is no difference between the coastal, Piedmont, and mountains of what the rules are. So if they have 20 acres of timberland in the mountains, it's supposed to be harvested, which on a mountain, it's not easy to log as it is, on the coastal side where it's flat. But they are all supposed to be following the same regimen.
Right, and obviously harvesting methods may be a little different there.
Yes.
Yeah. All right. Okay. So, all right. So on one of your slides, you talked about the $3,000 per acre income requirement in 3 years. Did that income requirement pertain to the forestry PUV or just to the ag and hort?
Yes. So your parcel has to be $3,000. So like if you have a 15-acre tract, that whole 15 acres has to be $3,000. So I may not have been clear or understand the question, but it doesn't have to be $3,000 per acre. Just your farm unit has to be $3,000 over a 3-year period of time. Agriculture and horticulture, they are the only two that have an income requirement. The forestry deferment only has a sound management requirement, which is the forestry management plan, only because the time frame that you cut timber is so vast. I know they have new generation trees where you can plant them and harvest them within 15 years, if I'm not mistaken. Some traditional ones still take 30 years to grow. So you may only cut timber twice in a lifetime. So that's why there is no income requirement for forestry.
Great. Okay. All right. So, Kayla, could you talk about the wildlife tax program? You familiar with that?
The wildlife, we only have one of them here in Pender County. That's something that's fairly new. It's a wildlife conservation program that we have, and it uses the agriculture rates. And so, we would just have a wildlife biologist that would go out to the property, and they would determine how much acreage is underneath that wildlife conservation easement. And then they pass it to the tax office, and then we assign it as the rates for agriculture.
Okay, great. We still got a few more minutes. So if you're good at answering a few questions, we've got a few more.
Yeah.
Okay, so this is a good one. All right, so if the land is used for both animals and for timber production, and it's over 20 acres, does agriculture or forestry classification make more sense?
Well, we have a couple in Pender County that are like that, but you only can receive like one program. So if you have 20 acres and you have your trees planted on there, then you may have cattle that graze underneath that. It just depends on your county, is if they would choose the forestry or if they would choose agriculture. You're going to be able to take and sell those cattle more often than you would cut timber. So that's something we probably would check with the Department of Revenue on. That's one of those questions that are kind of iffy. Your county may put it underneath agriculture, like I said, just because you do have livestock that's used also. So that's just something you'd have to speak with your county about.
Okay. All right. Is the PUV program as a whole being challenged, or are there landowners that are challenging to do away with that?
No, each year there are some laws that do go through the general statute. Some of them come about, some of them don't. But as far as the program going away, I haven't heard of anything about that. And I don't foresee that happening. I know there have been some rules where they wanted to lower let's say the agriculture is right now 10 acres. They tried to lower it to 5 acres a few years ago, but that did not pass legislative. So the Department of Revenue would be a good avenue to ask because they know the law changes faster than we do here at the tax office.
All right, a few more. Is there an acreage requirement for the wildlife conservation program?
There is. You have to have, I believe, at least 20 acres to start out with, and then like no more than 100.
So if I can jump in on that one just so people understand. It's 20 acres that are contiguous of wildlife habitat that is designated as priority habitat. So you might have 20 acres of forest land, but if that whole 20 acres of forest land isn't designated as a priority habitat or focused on a habitat of concern, then it wouldn't qualify.
Yeah, and basically, like I said, the wildlife biologists, they would have to let us know what's considered, what they have underneath the wildlife.
Right, so that brings it back to why it's so important to really figure out your objectives on your property and then talk with those professionals, the forestry professionals for forestry, your agriculture professionals like FSA, and then your wildlife biologists. And then go talk to your county tax assessor office as well. And that way they can understand. Okay. Well, we have a few more questions. If you want to continue, there is definitely a lot of questions about this topic. So you're doing great. So as long as you're good, we'll keep on.
Yeah.
Okay. So if you qualify for a wildlife easement, do you still need income like in the agriculture PUD?
It depends on your county. I know Pender County doesn't have a different valuation for wildlife conservation. It still would have to fall underneath, like it would fall underneath agriculture more than likely.
Okay. Okay, and I think we had another question about the acres for the wildlife conservation program. Do at least 10 acres have to be under the wildlife easement? Is there a minimum acres?
Not that I know of, but like I said, we only have one in Pender County, so you may want to call someone from Department of Revenue about that one.
Right, and this is a new program, and if I remember correctly,
yeah, it hasn't been out very. Yeah, it hasn't been out very long. I know it's a lot of counties in the mountains. They have more that are underneath that wildlife conservation easement than we do here.
Right, and I think they were trying to make some changes to that program as well, and they have those several different priority areas.
So just so folks know, Jennifer, I posted a link to the Wildlife Resource Commission's website that will take you to all kinds of information related to the program for wildlife.
Perfect, and that would probably be your best bet, because as Kayla said, they've only got one in Pender County. And,
yeah, sorry.
And that's a good one. I mean, there's a lot of folks that are still learning about that wildlife program, but it goes back to those priority habitats, as Bob spoke about. And you've got to have, I think I want to say there's 7 maybe, but it is a little different, and it seems very different from the forestry and the agriculture, at least from what I've read. So I would take a look at that brochure that Bob has posted. All right, so let's talk about wetlands. What about the wetlands requirements? Is there a size and classification that could be included, or?
There's not as of right now. Like I said, I can speak about what we do here in Pender County, but for the wetlands, we have a lower rate that is less than what the use value program can give. So at that point in time, we don't assign use value to the wetlands. We have a wetland rate that we give, but there's no minimum or maximum on that. So, I mean, if it is wetlands, then, we would designate that with our wetland layer.
Great. Okay. All right. I'll just make one more statement. So we've had some folks, we got a lot of questions about the wildlife habitat conservation program, but you're probably best to go to that link. And the agency that handles that program that Kayla is speaking about is the North Carolina Wildlife Commission. And I think Deanna Noble might be typing some more information there as well. So talk with your wildlife biologist from the North Carolina Wildlife Commission more about that program. All right, Kayla. Well, I think that's all the questions we have for right now. And I guess we didn't really make it clear at the beginning, but at the end of both of our speakers, at the end of our meeting, folks that need to go can go because they've heard the information. But if folks still have more questions, they are free to stay on. We'll be here till 3 o'clock, and they can continue to type in questions in that chat, and maybe we can address those some after 2:30. But I will say, as a forester, I have to say that the present use valuation program is a huge benefit for a lot of our landowners in North Carolina. And so hopefully if those objectives line up with your property objectives, then you're able to take advantage of those programs. But as we know, some landowners just have a different objective. And so that program may not be for you. And if that's not, that's your decision as a landowner. So, all right. Well, thank you so much, Kayla. That was wonderful. A lot of great information. We appreciate your time.
Thank you.
All right, great. Okay, well, we have done with present use valuation, and we have another wonderful speaker coming up. And this is Mavis Gragg, and she is going to, title of her presentation is Standing on a Lot of Love. So love that already, Mavis. And so Mavis, if you want to take that away, and we will not delay any further.
Thank you. Good afternoon, everyone. Can you hear me okay?
Yes.
Oh, great. Awesome. So yes, we're going to talk about estate planning basics, but first let me just share a little bit about myself. I am the director of the Sustainable Forestry and African American Land Retention Project with the American Forest Foundation. Any of you who are in the Roanoke Electric Co-op service area may be familiar with this program as they participate in it. And my background is as an attorney. So death and dirt is the most simple way to explain the type of legal experience that I have, working with families to plan for the present and the future, and then also working with families to resolve issues, real estate issues that impact their ownership. I'm also the chair of the North Carolina Parks and Recreation Authority. So we're the entity that allocates funds to state parks as well as to local government for parks and recreation. And I'm a member of the Triangle Land Conservancy Board of Directors. My email is here, and we can also post it in the chat box, but it's simply mgragg@forestfoundation.org. So today we're going to talk about estate planning. I do have a lot of information for you all, but I'm also curious about you and your own circumstances. But estate planning is essentially planning for taking care of ourselves when we aren't able to take care of ourselves or when we need someone to step in, and taking care of our assets and our loved ones when we pass on. When it comes to land, to real estate that we own, I think more broadly we should consider succession planning. So planning for success, of course, but also just planning for who will succeed you in management and ownership of your land. And so we'll talk about a particular type of tool that is helpful for succession planning with your real estate, as well as the basics of estate planning. And before we delve in, I'm curious to hear from you all whether you have an estate plan. So if you will, just use the poll and let us know whether or not you have an estate plan. And Robert, I don't know if I'll be able to see the results. Our folks answering. All right. Okay. So we have some people who said yes. 31% of you said yes, you have an estate plan, and 69% of you said you don't have an estate plan. I have a big surprise for you all who say you don't have an estate plan. All of us have an estate plan. You either have a customized plan or you have what I would describe as the government plan, which we'll talk about in just a second. But first, let's talk about assets, because a lot of times when people don't have estate plans, there's a belief that what they own, the assets that they have, don't merit a plan, but it certainly does. And for those of us who work with families to plan, there are 3 buckets of property that we consider, and the treatment of each of them is unique. So one bucket is real property. So that's real estate. That can be your primary residence. It can be rental properties. It could be family property if you own property with your family. It could be a vacant lot. But any real estate is a bucket of assets. It's a particular category of assets. And how ownership of real estate passes through inheritance is different from how other types of property, other assets pass. And the ways that we can plan are also unique. So that's one bucket. The second bucket is tangible personal property. So think of things that you own that you can touch that are not real estate. So it can be vehicles, it can be your furniture, your clothes, anything that you can touch and own as an asset, that's called tangible personal property. And then the third bucket is intangible personal property. That intangible means that we can't actually touch it. So think about your bank account, your retirement accounts. Those aren't things we can touch, but they are assets that we own. Business interests, to any of you who own a business, maybe you have a limited liability company. Well, you are a member / owner of the limited liability company, and that ownership interest is an intangible personal property interest. Insurance policies, intellectual property, those of you who have created something, that intellectual property is an intangible personal property. So 3 buckets of property that I think are important to consider, and understand that it's important to address each of those buckets of property because the treatment under the law is unique. So let's go back to that government plan. Remember, I told you that everyone has an estate plan. You either have a plan that is customized for you, or you have the government plan. So when it comes to your assets and what happens to your assets when you pass away, particularly your real estate, if you do not have a trust or LLC or a will that addresses your real estate, then the state law kicks in. And this is the government plan. So if you have children but no spouse, your children inherit everything in North Carolina. And that is good for some people. For many people, they want their children to inherit the real estate. If you have a spouse but no descendants or parents, so if you don't have any children or parents who are descending from this, sorry, actually this is North Carolina, so that's incorrect. So North Carolina, if you don't have any descendants, it doesn't matter if you survive by parents. But if you, actually, yeah, sorry, I switched over from my Georgia slide, so I just want to make sure I'm telling you the law correctly. So anyway, if you have a spouse but no descendants or parents, then the spouse inherits everything. That may be fine for folks. If you have a spouse and one child or descendants of one child, so say your child predeceases you, but you have grandchildren or so forth, then it's split 50-50. And then it gets more complicated. So if we add more children to the mix, then the spouse and the children inherit shares and they own together. So if it's real estate, for example, that you've owned separately from your spouse, your children and your spouse could become co-owners in the future. And then it gets even more complicated. So let's say that you have separate property from your spouse, separate real estate from your spouse, and you don't have children and you pass away before your spouse and your parents. Well, then they will share in ownership of that separate real estate. And then, of course, if you don't have a spouse or children, it goes up to your parents, which may be okay. But if you think about, those of us who have parents who are much older, inheriting these kind of assets could complicate things from them as it relates to government benefits and their own economic stability. And then it gets even more confusing if property is going up to out to your siblings and descendants of those children, descendants of the siblings. So the government plan, my point about this is that the government plan may not actually suit your needs, but all of us have an estate plan. And if you don't have your own customized plan, then this is what would happen to your assets. So let's talk about what is in a customized plan. So these are the types of estate planning documents that are important to consider. And that's a great question, Mary. What if there are no relatives in intestate succession? So I think that if we think about the family tree, like a generic family tree, we have, and any individual has parents, you may have siblings, you may have a spouse, you may have children, grandchildren, etc. So we first look at what happens to, well, we first look at whether there's a spouse and children. So we look at your immediate family. And then the law, if you don't have a spouse and you don't have children or descendants of children, then the law says we look up to parents. And if your parents aren't living, then we look down to their descendants. So do the parents have other children? And if they did, then we would, the assets would go to them. But if there were no other descendants from your parents, then we go up to your grandparents on both sides. And then if they're not alive, which most likely they wouldn't, we would look at their descendants. It's pretty hard to get to a point where there are absolutely no family members. I think it's possible in special circumstances, for example, people who are adopted and there's literally no pathway to identifying their biological family, and the adoption would sever rights anyway. So it's pretty rare. I haven't actually heard of any cases in our current time of there not being any heirs and the property going to the state. But to answer your question, that was a long answer, but to answer your question, if there are absolutely no heirs in that person's family, then it goes to the state of North Carolina. And that's the same case in other states as well. All right, so documents. So when we are talking about getting a customized plan, there are different documents that we want to consider, and there are different reasons for having these documents. So power of attorney documents. Power of attorney documents are documents where you are appointing someone to act on your behalf, and they are only effective while you're alive. This is not a tool for disposing of your assets when you pass away or giving authority for when you pass away. As soon as you pass away, the power of attorney terminates. As soon as you revoke the power of attorney document, it terminates. But it's a very powerful document, and there's different reasons why we want to use one. So there's financial power of attorney documents in which you're appointing someone to act on your behalf for all kinds of financial matters, business matters. Essentially, they can do the same things that you do with your stuff. And so it's a very powerful document. And yes, there is a state form, and there are online forms that you can get for a power of attorney document, but I'll let you know that it's very easy to give a lot of power to someone using the form document. And you want to be able to assure that the document is doing what you need it to do. And your circumstances may be very different from the average person. And so it's one thing to think about with the power of attorney document, the financial power of attorney document, is when it's effective. You know, is it effective immediately, and does that actually help me? If not, then you should have it effective upon some kind of condition. Most often the condition that people will have the power of attorney become active is if you become incapacitated. And so if you have a power of attorney document that's effective only upon incapacity, it's important to know what how capacity or incapacity is determined. So very important document, but it's really important to have one that's customized to your needs so that it's effective for what you want it to be effective for and not effective for things you don't want it to be effective for. The second type of power of attorney document is a healthcare power of attorney. And in that document, you're appointing an agent to act on your behalf for healthcare decisions. And again, you have the opportunity to customize it based on your condition, your circumstances. And so you may want someone to make all of the exact types of decisions you would make if you were able to, or you may just want them to make certain types of decisions. A good example of where you might want to limit the agent's authority is if you, sorry about that. A reason you might want to limit your healthcare power of attorney agent's authority is if you, for example, have a living will, which is a document that informs on whether you should get artificial treatment or whether your life should be artificially prolonged. If you have a terminal or incurable condition, you could say, okay, my power of attorney can make all decisions, but they can't make end-of-life decisions. So that's also an important document to have. And I encourage you to be thoughtful about what terms you have in that and what best suits yours. And that's why the form document, downloading documents offline probably isn't going to get you what you need. So there are other healthcare directives. You can do a HIPAA release. So, there's a lot of restrictions on sharing of information. And a HIPAA authorization and release, you're just naming people who are allowed to receive information from your healthcare provider. And the people you name don't have to be your agents. They don't have to be fiduciary. It could be that you want your adult children to know, but that perhaps your spouse is the one who actually is the agent in your power of attorney. So a HIPAA authorization and release is a healthcare directive that you can have, and then a living will. A lot of times people will use the term living will, and they're referring to the document that disposes of your assets when you pass away, but that's not what it's for. It's literally related to the end of your life and whether you should receive medical care that artificially prolongs your life. And so a living will is saying, hey, if I'm in a terminal incurable condition, or if I'm in a vegetative state and there's no chance of that reversing, I do want you to artificially prolong my life. Or you're saying, I don't want you to artificially prolong my life. It doesn't mean that they're going to just pull the cord, because I think pull the cord sounds pretty harsh, but it does get kind of, part of it is not providing hydration and not providing nutrition. It does include, you will still get pain relief, but it's measures that would actually prolong your life. And so it's really important to have those kind of healthcare directives. Another example of a healthcare directive that you can have is a mental health directive. So this is really great for people who have some sort of mental health condition. It can inform of who you want to step in to take care of you, who should be called instead of calling the law. And our Secretary of State office actually has a registry where you can have your mental health directive saved, and those people that you have appointed with authority to access that document can simply go to the Secretary of State's website and collect it should some event happen. So those documents are great. These documents are used while you're alive. These documents are not effective after you pass away. So the power of attorney documents are not sufficient for planning for when you pass away. But now let's talk about documents that we do use to address our assets and management of our affairs after we pass away. The first one, which most of us are probably familiar with, is a will. So a will is a legal document that is used to inform the public and family and loved ones of the person who passed away of who is in charge of settling their affairs, the priority of spending the assets in the estate. And typically folks will say in their will they want all their debts to be paid and taxes, et cetera. That's standard language, but I think it's language you should pay attention to. And then it says who gets your assets. And sometimes you can even plan for people who can't take care of themselves and how they will benefit from the assets that you have and who might take care of them. So you're using it to inform of who's in charge. You're using it to inform of who gets what. You can, if you have minor children, you can appoint or nominate rather someone to be the guardian. We cannot will away our children though. And so what would happen is if you die, have a will that nominates the guardians, that will be used as evidence. And the standard for the judge making the custody decision is the best interest of the child. And that evidence of you nominating folks in your will be important for those for that discussion. And so many times people, when they're talking about land and they're talking about agricultural land that's in the family from generation to generation, people will point to lack of wills as the reason why family real estate gets complicated. And I would say that a will is important, but it's not the key to planning for intergenerational real estate ownership within a family, because a will is personal to the person. You know, it's a one person's direction and it will only last for one generation. The law does not like for people to control from the grave. And so in addition to a will, it's really important as it relates to your real estate, you know, your forested acres, your farm, about other types of ways to manage it. And one way is a trust. So a trust is where a person is creating a relationship with a fiduciary known as the trustee, in which the trustee effectively has title to assets that the trust creator is transferring. So so for example, if I own a farm, a 40-acre farm, I can transfer the title to the fiduciary known as the trustee, and then the trustee has a duty of managing the farm and making sure that the farm as an asset is cared for, that the value is maintained, it's not grown. They have to make sure that the value doesn't decrease because of actions of their own, and they have to do it for the benefit of the beneficiaries. So let's take a look at what this looks like, because I know that it's a lot to consider. But here on the left where it says settler, that's the person creating the trust. And they're the person who's transferring the asset to the family trust, i.e. the trustee. The trustee is responsible for managing the assets of the trust and also making any distributions to the beneficiaries. The beneficiaries are the people or individuals or entities that are benefiting from the asset held by the trust. And what's really cool about this is that the settlor, the creator of the trust, the trustee, and the beneficiaries could all be the same person or people. So let's say that you personally own some real estate that you want to plan for staying in your family for future generations. You could transfer that and create a trust, and you could call it the Mavis Gragg Family Trust, and then appoint yourself. So I'm appointing myself, Mavis Gragg, as a trustee, and I'm the beneficiary. And then I can say in that same document, when I cease being the trustee, let's say I decide to step down as a trustee, here is the successor trustee, and they are now responsible when the initial trustee has stepped aside. And then when I no longer am a beneficiary, I can say that when I'm no longer a beneficiary, perhaps because I've passed away, then I would say who the successor beneficiaries are. And you can say blood descendants of Mavis Gragg or blood descendants of Harold and Kathy Gragg. Those are my parents. I don't actually have descendants. So I could say descendants of Harold and Kathy Gragg. Or I could say to the state of North Carolina or some charity. But the idea is that you're creating a vehicle or a entity for managing the property, and you're setting the terms that can last for multiple generations. And so you're not having folks become individual owners of the property. The ownership is maintained in the trust, and then the management of it, you're identifying successors in management, and you're identifying successors in benefiting from the property. So I'm sure you have questions about that, and we'll perhaps get through the slides and then go back to the questions. So moving on from a trust, another entity you could consider, which we won't talk about it at length here, is a business entity for owning your real estate. A business entity such as an LLC, a limited liability company. Now, the key differences in using an LLC and a trust are that with the LLC, you have to register with the state that you have created this entity, and you have to make annual reports to the state. Typically, the tax burden passes through to the individuals in each of those, so that's not necessarily a difference, but it is important to work with an attorney to determine what makes most sense from a tax perspective, because, depending on the income level, it may make sense for it not to be passed through to the individuals. Another distinction between a trust and a limited liability company is that the managing document for a limited liability company is an operating agreement, and the managing document for a trust is literally just called the trust document. So I don't think those are things that you should create on your own. You probably understood by now that I'm not a fan of do-it-yourself, especially when it comes to your assets, because there's so many different considerations, and even a general attorney or attorneys not specializing in this area, even they could miss miss some of these nuances. And so I highly recommend working with an attorney where you talk about your goals, where your goals around succession, your goals around growth and the economic value, your goals around preservation of resources, and then come up with the strategy that works for you as far as your real estate, but also your other assets. Now, remember I talked about intangible personal property, so things we can't touch, but that are assets. It's very important to understand that those assets often can transfer after your death through a contractual right, meaning that if you have a life insurance account, if you have a bank account, you likely are able to designate who succeeds you in ownership or who should get a payout of that account when you pass away. And I think it's important to consider planning in that way, naming beneficiaries rather than them coming through your estate if you can, because when any of these assets come through your estate, meaning like if, when we go down to the courthouse and we open an estate and we list all the assets, if any of those assets come to your estate, they have to be first used to pay the expenses of administering your estate and the expenses or the debts of your estate. And so let's say, for example, you have your biggest asset is your land, and then you have a $100,000 insurance policy. If you have that insurance policy go to your estate, like by either not listing a beneficiary at all or by saying on the beneficiary line to my estate, then, and let's say you have $200,000 in debt, well, if it goes to your estate, it's going to be used to pay the debt, and then your heirs are going to get nothing, as opposed to if you listed family members or your favorite charity or whatever. So it's really important to use the opportunity to list beneficiaries, whether it's a retirement contract, a bank account, a life insurance policy. List beneficiaries and be thoughtful about who is receiving what and why. And using, perhaps you have real estate and life insurance accounts, and maybe you have kids who want to be involved with the land and kids who don't want to be involved with the land. Well, then it makes sense to have some of those assets go to the kids who don't want to be involved with the land, and then have the real estate go to the kids who do want to be involved in the land. So be thoughtful about your intangible personal property and use the opportunity to include beneficiary information. Always list the primary, secondary, and even a third level of beneficiaries, because if you only list the primary beneficiary, if they die before you do, then it goes to your estate and gets eaten up by your estate. And then update them regularly. I've had estates where people have left property to, actually, I just heard a great example a couple weeks ago. This woman was divorced from her husband for like 8 years, and he died. He never changed his insurance policy, even though he remarried, and his ex-wife received this huge insurance policy and took time off from work for a couple of years. So make regular updates, and just know that you could list the trustee of your trust. So if you have a trust that's owning your real estate, you could list the trustee as a beneficiary, and then that cash goes into the trust. You could also have in your will a trust for minor children or for disabled heirs or spendthrifts, people who aren't careful with money. You could have it go to the trustee that's established in the trust or in your will. Other considerations around estate planning include taxes. So most of us are not subject to, most of our estates would not be subject to an estate tax. An estate tax is something that the federal government, not North Carolina state government isn't currently doing this, but the federal government, if your estate, if all of your assets at the end of your life are worth $11 million and some change or more, then your estate has to be taxed. And it's a really hefty tax. That particular threshold will sunset in a couple of years. So it's always important to stay mindful, because the threshold has been as low as below $1 million, with which if you have real estate and retirement accounts and life insurance accounts, you could easily pass the threshold. So pay attention to the estate tax, even if you're not wealthy. most of us are not wealthy, but eventually it could come back to a threshold that means lots of us will have to pay. And then a lot of times people like to make gifts before they die instead of it going through an estate. And I get this logic. You want to lower the cost of the money that's going to expenses and administering your estate. But just know that there are gift taxes, and I think the current threshold for a gift tax is $17,000. So particularly with real estate, let's say you decide to give your real estate to your kids while you're alive rather than having it go through your estate. Well, if the value of the shares that you're giving to your kids is over $15,000, legally they are responsible to pay taxes on that. And then always just do your taxes. I have a state where people have spent thousands of dollars working with an attorney because they have complicated income tax issues. And I know not all of us believe we should do income taxes, but we are required to by law. And I just want to point out that that can become a hefty expense on the other side once people have passed away if folks haven't done their income taxes. And then the last thing about taxes that I want to point out is the previous administration also established the Secure Act, and the Secure Act does lots of things. And one of the things that it does that impacts most of us is it says that for retirement accounts that are inherited, they have to be spent down within 10 years. And so, for example, let's say I have a retirement account with $90,000 in it, and someone inherits it. Well, they have 10 years to spend it down, 10 years to spend $90,000, which means that it actually will trigger a tax. So the value will probably be cut in half, and then they only have 10 years to spend that. That's a big difference from what most of us are familiar with inheriting retirement accounts. There are exceptions if the person inheriting is your spouse, a minor, or a disabled child, and there's a couple of other exceptions. But the exceptions probably don't apply to most people who are adults and are not married. So pay attention to that as well, because you may want to if you're using financial instruments, financial, intangible personal property as a way of growing your wealth, focusing those on your retirement account may not be a good look because of these changes in the law. And so that also begs for working with an attorney and or an accountant who understands the Secure Act. All right, so mistakes to avoid, unintentional disinheritance. I have seen this. That's where someone is creating their own will. For example, maybe they're doing a form online and they unintentionally disinherit someone. It could be a typo, it could be some sort of misunderstanding about what the section is dealing with, but it's important to work with an attorney, I would say, so that you assure that you meet your goals and who should be inheriting from you. Also, many families create what we call as heirs property. So that's simply real estate that's owned by a family from generation to generation through inheritance. Owning property with the family makes a lot of sense. It's intergenerational wealth. It's really important. However, the legal structure that many families own their property in is such that it's vulnerable to predators. So simply dying and passing real estate creates multiple owners. And the way the law works when you have multiple owners of real estate, whether they're family or not, is that any owner can transfer their share to whomever they want, including people outside the family. And any owner, whether they're a family member or not, can go to court for what's called a partition proceeding. And in that partition proceeding, they're either asking for the land to be physically divided, and if the land can't be physically divided, they may be asking for the land to be sold at auction. And so the legal structure of inherited land opens families up to predation, to predators. And so it's important to, in your estate planning, not create it and actually be intentional about avoiding creating that kind of legal structure. And that's why the suggestion around using a trust or LLC was made, because that's a way that you can avoid creating that legal vulnerability. And then deeds and spouses. So lots of people think that deeds are an estate planning tool. So a deed is a legal document that we use to transfer ownership of real estate. And a lot of people will use deeds, but you can actually create more issues with deeds. And sometimes people create issues as it relates to spouses because let's say that you have a blended family. Maybe you had some real estate before you got married and you want to give this property to your children. And you say, well, it's my property. I'll sign the deed to my children. And you didn't include your spouse who never owned the property, who is never going to own the property. Well, guess what? Your spouse should have signed it because your spouse has a future interest in your real estate. And so be careful with these and particularly pay attention to how it impacts spouses if you're married. And then trust. So I'm here advocating for using trust for multi-generational real estate ownership in a family. But pay attention to how you operate with the trust. It's possible to dissolve the trust or to take action. You could take action that dissolves the trust and then leaves you hanging, leaves the assets in a lurch, meaning that we just revert back to the state laws. And so take care to maintain and assure that the instruments that you're using, the strategy that you're using stays intact. Don't make rash actions that could actually undermine your whole plan. So getting started, many of you may be overwhelmed by now, but I don't want you to be. I think the first thing you can do, and even if this is all you do for the next little while, is write down what your goals are when it comes to planning for taking care of yourself if you can't take care of yourself while you're alive, and what happens when you pass away. And so you might just want to write down and say, hey, I want to make sure that my sister and my best friend are the ones who are taking care of me if I can't take care of myself. I want to make sure that, if I have a mental health break, that these are the folks that come to my assistance. I want to make sure that when I pass away, that this real estate that I've nurtured and invested so much in stays in the family and perhaps stays in control of the women in our family. So you can just set that out, set your goals out. And then when you do begin working with an attorney, they typically are going to have you fill out a questionnaire. And if an attorney that you're going to do estate planning or succession planning does not provide you with a questionnaire, that would be a flag for me about their thoroughness. So make sure that you just check in to see, what they offer, and that they are going to be thorough in asking you questions so that they can help you build a strategy. And then it's also possible, to take those goals that you have and simply get a consultation from an attorney. You don't have to fully commit to doing the planning. It may be useful for you to meet with an attorney for perhaps an hour, hour and a half, talk about your goal and what the options are and what the cost could be. Because I understand sometimes these may be very difficult decisions that you need time to act on. And the cost may be such that you want to plan or need to plan for covering the cost of doing the estate plan or the succession plan. Especially when we get into tax advice and strategy around the entity that should own your real estate. So a consultation at a minimum could just help you understand what's possible for the goals that you have and what the next steps are. And then you can be more strategic in pursuing it. Because I understand a lot of times we will go to an attorney and say, I need an estate plan, and the attorneys will just jump right into it and not really get a big picture. And so it could just be helpful to invest in a consultation. And I've never seen the opposite, but most times an attorney that will do a consultation, if you decide to get the full service, they'll just add that consultation fee into the full service. So you don't have to pay extra money if you engage them. So that's all I have. I think it's important to talk to your family members. Think about all the assets that you have and what buckets they fit in. Make sure that your beneficiary forms are up to date. Make sure you understand what's going to happen with your debt those of us who have student loans, it's a good look to figure out what happens with those student loans when we pass away, because that could impact your plan. And be thoughtful about who is standing up for you. Some people may be good at taking care of kids, but they suck at taking care of money. Some people are good at making healthcare decisions, but they are not good at taking care of kids. Be flexible. You don't have to pick the people just because of what their relationship is to you. All right. So you have questions?
Oh, yes, Mavis, that was wonderful. And we do have several questions for you, so we still got 5 more minutes. So we'll just start with the top. All right, so what is the value of estate that can be transferred before estate taxes are due? Federal versus state tax.
Thank you, John. The current threshold, so this is every asset you own. The current threshold is a little over $11 million. So that's not most people. And I know as recent as I think 10 or 15 years ago, it was around $1 million. So we have to pay attention to those changes because it does change, you know, it seems to change when the administrations change. So it's possible we'll see a change now or in the near future. I don't know. I haven't seen any indications that we will. Okay, so then an anonymous question. Someone has an 86-year-old mother who doesn't have a will and refuses to deal with this, and that some of her real estate, 2 properties, or 2 of the 5 children are on the deed, and one of them is living. So the answer to your question as far as what happens when your mother passes, it depends on the ownership that is expressed in the deed. So if the deed where your mother is transferring the property to herself and those 2 children, if it says joint tenants with rights of survivorship, then the property will go to the survivors, those who survived your mom. And so let's say, for example, your mom has 50% and the 2 children have 25% each. Well, then at the end, if your mother passes away and they have joint tenants with rights of survivorship, then it would they would each have 50-50, and the other 2 children would not be owners. Let's say though that it just says to myself and my 2 children, and it either says nothing else or it says as tenants in common. Well, what would happen then is that when she passes away, her share will be split among her 5 children. So sorry, this answer is assuming she doesn't have a spouse. So if she doesn't have a spouse, then that's what I think would happen. But if she has a spouse, then that actually changes it. The spouse also would get a share. So the key is, if you can look at the deed that has the property into your mom's name and the 2 siblings, is to see if it says anything about rights of survivorship. If it doesn't include that language, then those 2 children that are on the deed will likely just have a bigger share than the others. If land is owned in a trust, is inheritance taxes and the rules that are being looked at now a non-issue? So, when you say inheritance tax, I'm thinking of the estate tax, meaning that the tax that's happening on the value of the estate, and the estate is that person's assets. The trust, if you put ownership of your assets in a trust, you no longer own the assets. The trust does, even if it's for your benefit. So the answer is no, the estate tax does not apply to the trust. In fact, people use trust as a way to avoid the estate tax or the inheritance tax. Secure Act, 10 years if a non-spouse beneficiary. Yeah, there's I think 4 other exceptions. Yeah, I think there are 4 or 5 exceptions to that rule, but it's important to look at. Can you give an example on how dissolving a trust could happen? And actually, dissolving the trust or not even funding the trust. So I've heard of situations where someone has created a trust, and then perhaps when they get older and their mental capabilities change and they get anxious, and maybe they make changes to the trust that actually make the trust not exist, like they transfer title out of it or something like that. Another thing is that people will have a trust and they never actually transfer assets to the trust, which effectually does nothing for you and makes the trust of no value. So it's really important to, have provisions that can ensure that the fiduciary, as they age, the trustee as they're aging, that they can't make changes that could undermine the overall goal. And sometimes folks, with dementia or other cognitive changes, make changes that actually do away with the effectiveness of using a trust. You mentioned 60 days to put back into the, oh, that's not for me.
Yeah, so if we want to, sorry,
Okay.
Mavis, sorry to interrupt. If we may just want to save these for after 2:30 to stay on our agenda, and we can go ahead and have some closing remarks. And then that way folks that still have lots of questions, particularly some of the more detailed questions, like the one you went through about with their mother and kids, then we could stay on and maybe discuss that further for folks that have that. So if we could just, if you still have questions for Mavis or for Kayla, please continue to add those in to the Q&A function. And we'll just have a few closing remarks here. And then if you want to stay on, keep sending those questions in, and we will get Mavis and Kayla and some of our other ForestHer panelists to help answer some of those questions. All right, well, that is great. Mavis, that was a wonderful presentation, a lot of information, and definitely very important. And I know we never want to think about what's going to happen to us if we don't want to think about us getting sick or not being able to care for our children or for our family or our spouses, but so important for us to consider that. And a lot of us, you feel like you don't own much, right? If you watch too much TV, you feel like you don't own much, but you really do. And it is important for all of us to kind of stop and think about that. So thank you so much, Mavis. With that, let me share my screen back here. All right. Okay, so, all right. Well, two wonderful presentations today from Kayla and Mavis. And this was, of course, our last virtual workshop, the last meeting in our series for Protecting the Woods. But also, this is our last virtual workshop that we have scheduled or we have planned out. So what is next for ForestHer? We're not sure. We're still trying to figure that out. So we are going to take a break in August, and we're going to come together back in September and figure out how we need to move forward. So hopefully everyone out there received a survey in your email, and everyone had the opportunity to provide some comments or requests for what you want to see in the future, concerns that you have or things you want to ask questions about. And hopefully you gave us some comments about how comfortable you are coming back to an in-person workshop like we used to have prior to the pandemic, or if you prefer a mix of being virtual as well as in-person, or maybe if you'd be interested in a field tour and feel comfortable with being outside and actually looking at some examples on the land. So hopefully you provided some of that information to us. And over the next month, we're going to take all that information and we're going to work up a plan, and we're going to figure out what is going to be next for ForestHer NC. So we hope that everyone out there will stick with us and look for those updates in the future of where we might go, of where this group might go next. So please stay tuned for more information about our upcoming workshops. In the meantime, we're always out there. You can try to connect with us. If you're a Facebook person or an Instagram person, you like social media, please connect with us on that. You can keep up to date with us. If you're not a big social media person, but you have access to email, feel free to send us an email if you have questions or thoughts or requests, or you just want to become part of ForestHer NC and help us continue to provide these programs to women landowners across the state of North Carolina, and try to landowners and to professionals, and try to help build this group and improve our reach so that we are getting to people across the state. We want to be an inclusive group, and we really are striving to help reach some of those people that have not really been helped in the past, or maybe just are not sure who to turn or where to help or who can help them. And that's what we're here to do and trying to do. So please send us an email, reach out, and hopefully soon we'll have a website coming too. So maybe that will be something new come September that we can offer as well. All right, well, with this being our last webinar, we did kind of want to take a few minutes and just remind folks as you leave this meeting, an evaluation will come up and ask, what did you think about Mavis's presentation? What did you think about Kayla's presentation? And that is all information that we use to better serve you. So if you just take a few minutes and kind of answer some of those questions, we are very appreciative of that. It does help us. We do use that. We do take your opinion into account. So please take a few minutes and fill out that survey. But at the same time, since this is kind of our last planned ForestHer event for right now, we've got some coming in the future. We did just want to take a few minutes just to kind of, for the ForestHer, the group that is part of ForestHer that is on our webinar today, if they just kind of wanted to turn their cameras on and maybe we can see who they are and just kind of thank everybody for being here today, for showing up, for being interested in what these programs and with the information that we can provide to you. So folks we've got on there. All right, so Deanna Noble, Deanna, North Carolina Wildlife Commission. So those folks that had a lot of wildlife questions about the PUV, Deanna is on there. She's down in the eastern part of North Carolina. Let's see, my screen is not coming up. I saw Amy Tomcho on there a while ago. There she is. She's with Audubon, so she's up there in the mountains. So if you don't know Amy, reach out to her. We've got Kelly Douglas. There she is. She's in Raleigh. And she previously worked for Wildlife Commission, but now she works for the USDA, the APHIS program. All right, and we've got Leslie McCormick on there with the North Carolina Tree Farm program right here in Raleigh as well. So hopefully many of you are familiar with her. And we've got Laura Pravat, who was with the North Carolina Wild Turkey Federation, who is also down east. I know I'm missing several people that I know that are not on this webinar, but we've got a few more folks. We've got a lot of people behind the scenes. Dakota, and I apologize because her last name just escaped me. She is our social media representative. She is with the Forest Stewards Guild up in the mountains. I feel like I'm leaving a lot of people out, but we all did just want to come and say thank you so much for joining us today and for joining us previously. And if you have any questions about some of our previous meetings, check out that ForestHer NC YouTube site. Make sure you type ForestHer NC for North Carolina. That way you reach our programs and not something else. But check those out and review those as many times as you need to. And as you have questions, feel free to reach out to us. We're available to help you. So everybody, if you want to have a big round of applause, or we just want to say thank you all for joining us and taking the time to be with us today. So thank you so much. That's awesome. And so it's 2:30. So for those of you that if you don't have any more questions, but you wanted to stay on and hear some of the questions that others have, please feel free. We're going to hang out here till about 3 o'clock. And if you have more questions, continue to type them in the ForestHer or type them in into the Q&A box. And we'll discuss that as we speak for Kayla or for Mavis, or if you have any other questions for any of the panelists that are up here. And of course, I did forget Bob Barton there, who is always behind the scenes with NC State Extension and is helping us run this and making sure these virtual programs are going smooth. So we appreciate that very much, as well as our closed captioning group that has been helping provide that service as well. All right, so more questions. All right, what do we got? All right, so Kayla, it looks like we've got one for you. All right, so is clear cutting the only option for harvesting to stay in the PUV program?
You would have to harvest it, but like I said earlier, you could choose to harvest one section of your property and then plant it back and then harvest the next, but you still would have to completely remove the trees and then plant them back to keep the cycle going again.
Okay. All right, and can I just add to that, Kayla?
Yes.
Of course, you know, each county, and correct me if I'm wrong, please, if I'm speaking out of turn, I'm not a tax assessor, I'm just working with landowners. each county runs their own program. So being
Yes.
familiar with your county tax office and understanding the forest harvesting methods in your area and working with your forester and getting that information from your county is significant. Is that correct? Would you say that?
Yeah, the program, like I said, it's the same for all 100 counties, but each county is going to interpret things a little different. At Pender County, we try to go by the general statute, and the classes that we've been to says that the property does need to be clear cut some way. I know a lot of people don't like that, but they just wouldn't be able to be in the program if it's not going to be cut. Like I said, you can do it in different stages, but at some point in time, those trees would have to be clear cut and then planted back.
But definitely the need to work for a forest, to talk with a forester if you
Yes.
have those questions.
Consulting
because-
forester, registered forester, forestry service, they are all great avenues and will help get that rolling for you.
Right. So a lot of options out there. And I guess I tend to use the more, and correct me if I'm wrong, but I work with landowners. I use the word passive management versus intensive management. And landowners are all different, right? But
Yeah.
Maybe they're not aggressively managing their timber, but they still need to manage the timber to be
Yes.
involved in that program. Okay. All right. Let's see. All right. So Kim has said she was given 10 acres from her mom, which had been combined with other forestry PUV.
Mhm.
The rollback kicked in. But since the rollback, she has inherited more forestry land, over 20 acres.
Mhm.
So can she put the original 10 acres that she received the rollback, can she put that back into forestry PUV?
Yes, as long as she is managing that for timber production. So she has her 20-acre qualifying parcel already. So then after that, she can have piggybacking parcels. And like I said, that would be anything that's below 20 acres. So she has her new 20 acres that she inherited that's in use value, and she can also add that 10 acres back in. That 10 acres would have to be added in during the listing period, which is January 1st through 31st. So that particular landowner could put that 10 acres back in as long as it's being managed for the timber production.
Great. All right. So we know we have more questions out there. I feel like we had more questions about PUV as well as Mavis's topic. I know there was a lot of questions that I feel like that were coming up or that we heard from folks before this webinar. So if you have them, if you've got questions, please type them in the Q&A, and now is a great time to talk about that, particularly if you have a specific example that maybe you wanted to share. And maybe we can help answer that. Right now, these are the only questions we have that are in front of us, but hopefully we'll have somebody out there. We've still got 43 folks with us that are out there. So if you have a question, please feel free to type it in. Now's the time to get them answered. But in the meantime, great presentation. I think a lot of folks will have the opportunity to go back through YouTube and review those presentations and really take some pictures of some slides. I know I was taking some pictures of some slides from Mavis's topic from estate planning. I know that's a weakness of mine personally, so definitely have to catch up on that as well. Can't seem to be able to use the question and answer. Okay, so I'm not sure if there's a problem with the question and answer. Luann, if you're out there, or if you wanted to type it in the chat, can you type it from there? Looks like they're having a little trouble with the Q&A function, maybe not coming up correctly, but anyone else have any more comments? Mavis, did you have any more comments with your presentation? I feel like we kind of cut you off there, but or Kayla, did you have any other comments you wanted to say?
I don't. Like I said, I would just encourage everyone to reach out to the local tax office and just see if they don't have property and use value, just to see if they would qualify. Never hurts to try. I had a gentleman come in today. He had his forestry management plan in, he has application, but he had just purchased it from someone who didn't have it in the program. So I had to break the news to him that, he had to wait 4 full years, but he was okay with it. But we have people that, come in kind of all during the year just because they don't know about the program. So I would just, encourage you to reach out to your local tax office and just see if there's, if your property would qualify.
And that 60 days that a landowner has when they purchase a new piece of property from someone that had it in forestry PUV, and they have 60 days to enroll it in under their name. It seems like in the counties that I work, it's been across a little different in each county. Some folks, they're going to hold you to that 60 days to have that plan, but in some of the other counties, they're still holding you to that 60 days, but they're holding you to either receive some type of confirmation from that you have signed a contract with a forest consultant, or you have signed a contract with the forest resources, or that if you're providing your own, I'm sure they would like to see that. But if it's something that you had to get on a waiting list, and because everyone, does get backed up with these things, it seems like they're a little graceful sometimes.
So 60 days, I like I said, I can speak for Pender County, but I like to have the application within 60 days, because really there's no reason why you wouldn't be able to turn in an application within 60 days. But we do give, we have a little bit of wiggle room with needing the management plan, because we know there's fire season and everything like that. So we work with our forestry service here in Pender County, and if they let me know they're on the books, and if I get usually a notice from them saying, hey, it's actually going to be 2 months before I can get to it. We can wait up until a certain point in time. But if they're trying to apply in January and it's still September and they don't have a plan, then they need to find means of getting another plan. Because tax bills go out in September. So it's really difficult if we don't have the management plan by then. Tax bills go out, the deferment's not there, taxpayers will call us, but we have to have that plan. And from January till September, that's 8 months, so hopefully, the consulting forest or the forestry service would be able to get a management plan for them within that time. If not, we have a case by case, that we would work with them on trying to get a management plan. But I've never really had a problem getting a management plan because of that. So, our forestry service here is great to work with. I have some consulting foresters, registered foresters, as long as I tell them I would just like to be, updated. So if they'll tell me, hey, it's going to be 2 months, they'll just send me an email saying, have it ready next week or something like that. So just as long as they're in contact with their forestry service, consulting forester, tax office, just to kind of make sure everybody's on the same page, that's what I personally like.
Great. So definitely another reason why it's important for folks to reach out to those professionals, to that tax office, and really help understand that as you think about your property or go to purchase a new property, and don't delay. Time is of the essence. So don't be afraid to reach out. Those folks are there to help you. So, okay. So this looks like a question for Mavis. Mavis, I think she's still on. I'm sorry, my screen gets covered up.
So Jennifer, Mavis left at the thing. I posted, she said people can email questions to her, and I posted that in the chat. Okay.
All right. Okay. Well, I apologize for that. So we do have several questions. So William and Mary and an anonymous, it looks like you had several questions. So Mavis's email is down there in the chat. So she said, feel free to reach out to her. So if you want to email those questions directly to Mavis, I encourage you to do that. Obviously, she's a great resource and a wonderful speaker and has a lot of information to share. So reach out to that, and is definitely a very important topic. So we'll thank Mavis for being on here, and she had to jump off, but please send those questions if you have them to her. And I was going to try to repeat that email address out loud, and I can't find it, but anyway, so thank you.
The email address is mgragg, So that's mgragg@forestfoundation.org.
Okay, great. Awesome. All right. So hopefully everyone heard that and reach out with those questions. All right. Any more questions? Anything for Kayla? Or if there's something that you want to ask Amy of Audubon, or Deanna from the Wildlife Commission, or Kelly from the USDA APHIS program, or Laura from the National Wild Turkey Federation, or me from the North Carolina Forest Service, now's your opportunity. If we'd love to share something with you. If not, we definitely appreciate you joining us. We are really working hard to continue to create this community of women being able to come together and share, and maybe share your concerns, or share some of your examples, and maybe can help your neighbor, or maybe someone else in your community, so that we can solve some of your concerns. But we're out here. But anybody else have anything to say?
So Jennifer, you have one question that came in from Joanne Cox, asking, does she need to do a new forestry management plan every few years, even if there are no changes?
Okay.
You can send the tax office just like an updated statement, but I would say it's not necessary, because in your 8-year audit, that's whenever you would update your management plan. I have taxpayers sign a sheet saying they're basically following the current management plan that was provided, because sometimes you do have 15 years where it's just growing, but you would also still need to manage your property, make sure your boundary lines are marked, your fire lanes are there, you would inspect for beetles. So there's going to be stuff that you're going to do every year, but nothing major, like if you're not thinning it. So if you don't have anything major to update within that 8-year audit, I would basically just say, wait until your county audits you, and then you could say, I'm still following the plan that I submitted 8 years ago. We're just kind of like in a waiting period, but you are still, managing your property, like I said, by making sure your lanes are marked, and fire lanes are there, your properties boundaries are there, so you're still managing it. But and we do have some taxpayers that send us a management plan every 5 years. So it's not necessary, but if you want to do that, that's fine. I always tell taxpayers, you can never bring us too much information. So
Okay. Thank you, Kayla. Okay. So maybe if you're still out there, maybe you can help me. I think I missed a question here. So the question, oh, wait a minute, that's about it. All right. So my dad had 50 acres that he received from a family member upon their death. I don't want them to feel like he has to sell the land. So what are the first steps needed to start to find out how to earn money on the land, or to make the land better rather than just sitting on it? He's rented the fields to local farmers over the past few years, I think prior to the passing of the family member. And they're just so overwhelmed, as many people are whenever they receive a tract of land. Any suggestions on that? Recommendations, Kayla?
Like I said, he can put it in the program if he is managing that timber. But really there wouldn't be anything, he would have to do besides, get the forestry management plan in, and then, call the local forestry service and see if they could help get a plan for him. And like I said, he could just still, rent the land out to the tenants and stuff, and just, kind of hang on to it.
Okay. And what about starting a farm, or is anyone familiar about bona fide farm or starting a farm?
Pender County does have a bona fide farm program. One of the avenues is coming to the tax office. If you're already in the program, you can turn in a forestry management plan. That kind of helps you get up and going. But like I said, there's the 4-year ownership rule. So you could go ahead and start your timber farm now, but you really wouldn't be able to receive a tax office credit until that 4 years.
Now,
And that's
just from a farming standpoint or forestry standpoint, what I would recommend is they reach out to their local county extension office, talk to the agricultural agent to see what options are available for them as landowners to get into farming. If they want to get in more than just renting the land or something like that. There are programs and options there available to people that want to start up farming. So.
Yes, when you talk about starting a farm as a new landowner, there might be several people that you need to really talk with and find those avenues that will help you or provide those cost share programs or grants or benefits that can help you get started. But then there's the other side of it is to then, okay, well, how do you legally call yourself a farm? And that can be more farm service agency question. Of course, the Farm Service Agency to me is one of those groups that has documents on the land use. They have documented what crops have occurred on that tract of land, on those 5 acres, 10 acres over the years, and they've got so much data there. I don't know how much of that can be shared, but starting with them and finding if you've got a farm number or a tract number, and at the same time reaching out, as Bob said, to find those opportunities that may help you get started, because it is such a financial big startup. But then on the backside, talking with that tax office and seeing, well, now how can I be then say legally I'm a farm, and how can I be taxed at that lower farm use? So lots of good avenues there, multiple people that you would want to talk with.
So there's another question in the chat from Debbie. She's inherited land that is in the present use value program, but she wants to know, what does she need to do to continue with it in the PUV program, and what happens when it passes on to her children?
Debbie, you would need to go to your local tax office and tell them that you inherited the property. They'll get you to fill out an application, and then you would have to turn in the required documents, which if it's forestry, you'd have to turn in your forestry management plan. If it's an agriculture tract, you would have to turn in the past 3 years income from that property. So you would just need to go to them and get the application put on file. And as far as what happens whenever you pass it on to your children, it's really the intent of the new owner. So if your children would like to continue that same deferment you have, they would just need to, a deed would have to be recorded over to them. They would fill out the application and turn in the forestry management plan or income. But if they don't want to continue that, like I said, because it is a voluntary program, if your children don't want to continue with that, then a rollback bill will be issued to you, since you're the person who had it in use value. So it's really the intentions of the new owner. If you want to continue it, you have that option to do that now. And then when you pass it on to your children, they will have an opportunity to continue that. But like I said, if you don't want the property or your children don't want the property, then that rollback bill will be issued. And that's the deferment you've been receiving for 3 years, that will be due and payable. So you just kind of need to let the tax office know what your intentions are, if you want to continue that or not.
Okay, great. Luann, I think you were having trouble with the question and answer, and I asked you to type it in the chat, and then I totally scrolled by it and didn't see it. But Bob, maybe you can answer this question. I forget. Bob is a wealth of information for those folks that are not familiar with NC State Extension. And so Bob, can you answer this? Is a living trust good for timber property?
Yeah, it depends on each situation. I do know families that have set those, or I've heard of families that have set those up, but really I would highly recommend talking to an estate planner, lawyer, to figure out if that's best for your situation.
Okay. All right. So hopefully, Luann, hopefully you're still out there and I didn't bypass that. I'm scrolling way too fast here. All right. So we do have one more question that's come up, and Kayla, it looks like a PUV question. So let's see. All right, so he just purchased the land in July of this year
Okay.
and intends to enroll in the forestry present use. So as far as he can tell, it was not in PUV prior to the purchase, and he does not own any other land in PUV. So when would he be able to enroll it if he does not live on it?
So if you bought it in 2021, then you have to wait your 4 full years, which would be 2022, 23, 24, 25, 2026, January would be the first year that you would be eligible to apply if you don't have any intentions on living on it. So January 1st, 2026 will be the first year.
Okay. All right. And Bob, maybe you could help answer this one as well. So I don't mess it up, but it currently has merchantable timber, and the research that they've done is it is best to wait a year to harvest so that they then qualify for those long-term capital gains tax.
Right. To qualify for the long-term capital gains, you would want to wait 1 year and 1 day to ensure that you hit the 1 year mark before you harvest the timber, so that you get the long-term capital gains treatment. One thing I recommend doing, if you did not do at the time of purchase, is to make sure that they calculate the timber basis. That's the value of the timber, and that it is separate than the value of the land. So you paid a sales price, a price for the timber and land together. Often people do that as one entity, but it's recommended that you actually set up a land basis. So that's the value for the land separate from the value from the timber. That way, when you go to harvest the timber and sell it, that you're only paying taxes on the increase in value that's above the timber basis versus on the gross. So it's like paying on the net price versus the gross price for the timber. And if a consulting forester can help you with that process, if you don't already have a timber basis established. Also, I think it's important to point out from a forestry present use value program, you don't have to have mature timber on the property to be in PUV. The key thing here is that you're growing trees on the property. So if you harvest the timber in a year and you reforest it, or let's say it's 4 years down the road before you do it, and then you reforest it, and as long as timber income is your main goal, you should be eligible for PUV from that perspective.
Great. So two different things there. So we were talking about PUV, which is reducing your county tax rate, at the same time talking about income tax and how your long-term capital gains or the income that you generate from a harvest. So two different things, right, Bob? I want to make sure.
Yes, two different things. So
two different things there. So
PUV is strictly related to property tax. And then when we're talking about capital gains, that is strictly related to income tax.
And there's a lot of a wealth of information on income tax and long-term capital gains tax when it comes to talking about harvesting or owning land, as well as wealth of information on obviously the PUV program. Would be
an excellent topic for your a future event for foresters.
Most definitely, most definitely. Did want to mention Laura Pravat, for those that are still out there, did mention that if you're not sure that your property is in the PUV program, just maybe you're learning more about your property, then check the GIS website. So many of your county tax offices have a GIS program that is online, and you can go on there and find your parcel of land, and you can find your tax record. And in that tax record, a lot of times it will say a deferred use, or it may say farm use. A lot of times they'll use the word farm and forestry at the same time, but you may want to ask to ensure that of how it's listed at your county tax office. So sometimes you can find it online available for yourself, or if you can't, or if you don't understand that tax record, then definitely go in and talk with your local county tax office, and they can explain that to you. So all good questions. All right, so looks like we've still got a few more folks. If you got questions, send us to us. It's 3 o'clock. Feel free to email ForestHer@gmail.com if you have more questions. And don't forget to please click on that evaluation link as you leave this meeting. We'd love to hear from you. We'd love to hear your comments about how today was. And if you've got any suggestions for what you'd like to see next from ForestHer NC, we would love to hear about that. Alrighty, well, thank you so much, everyone. Kayla, once again, thank you for joining us today. Wonderful topic, great presentation. We'll also thank Mavis. I know she's not here, but hopefully her ears are burning, and we're saying thank you to her as well, and a wonderful presentation. And thank you everyone else out there. Bob, thank you for your support in this program. And Amy and Kelly and Deanna, Laura, Leslie, thank you very much. And I guess we will all see you sometime in the fall. So thank you again for joining us.